7221. That is the number that shouldn't have been on the screen yesterday. If you were watching the tape on the 5th, and I don't mean just glancing at the daily close, I mean actually watching the bid stack evaporate, you saw something that, well, it makes you uncomfortable. It's the kind of price action that makes you question the structural integrity of the floor you're standing on. We saw silver lose nearly 10% in a session, only to snap back to 75.15 by the early hours of the 6th. On paper, on the daily chart, it looks like a wick. It looks like a V-shaped recovery, a buy-the-dip moment. And sure, if you bought at 72, you're feeling clever right now. But you shouldn't be, because what happened between the open and that low wasn't trading. It wasn't a market discovering price based on supply and demand, or industrial output, or what the Fed is whispering about yields. It was a forced liquidation. It was a margin clerk at a clearinghouse hitting sell at market because some leveraged fund was getting absolutely destroyed in an entirely different asset class. Think about that. Silver didn't sell off because silver is weak. Silver sold off because the Nasdaq was bleeding, because the AI trade finally hit a liquidity wall. And when you can't sell what you want to sell, you sell what you can sell. And silver is liquid. Usually. Until it isn't. There is a specific signature to this kind of move. A crash followed by an immediate violent snapback isn't a sign of a healthy bottom. It's usually a sign of fragility. It tells us that the passive liquidity, the resting orders that usually absorb selling pressure, has been pulled. The order book is thin. It's hollow. And that's the part that worries me. Not the price. The price is just a number. It's the mechanism of the drop. Most people are going to look at this rebound to $75 and say, okay, the panic is over. The washout is done. We're back to fundamentals. I've seen that headline 3 times this morning already. Panic unwind. Healthy correction. I don't think that's what this is. I think we just got a glimpse of the plumbing failing. When a safe haven asset trades with a higher correlation to a tech stock crash than to gold or the dollar, something has fundamentally shifted in the market structure. The wiring is crossed, and there is one specific signal. It's buried in the open interest data on the COMEX, specifically regarding who was buying when everyone else was forced to sell. That suggests this wasn't just a random flush. It looks like a transfer of inventory, a massive one. If you understand who bought that dip, and more importantly, why the selling stopped exactly where it did, the next few weeks look very different than the standard bull market resume narrative. We need to talk about the liquidity vacuum because it didn't close. It's still there, waiting for the next margin call. And that vacuum is where the real risk lives right now. It's not in the chart patterns, it's in the behavior of the participants who are supposedly protecting themselves. See, the popular narrative, the one being pushed on every financial news network since the open this morning, is that silver proved its resilience. They point to that 5.5% rally from the lows and say, look, the buyer stepped in. The thesis is intact. But that interpretation completely ignores who was selling, and more importantly, why they had to sell. If you are holding silver because you think it's a non-correlated asset, something that zigs when the market zags, yesterday should have been a cold bucket of water to the face. Because when the AI sector rolled over, when those massive CapEx guidance numbers from Google spooked the street and the tech-heavy indices started dumping, silver didn't act like a gold's little brother. It didn't act like money. It acted like a high-beta tech stock. It collapsed in lockstep. We're talking about a correlation of nearly 1-to-1 on the hourly time frame during the worst of the sell-off. That is not a safe haven. That is a source of funds. This is a concept that gets missed in the noise every time. When a massive hedge fund runs a risk parity strategy or a highly levered macro fund gets caught on the wrong side of a tech trade, they don't sell what they want to sell. They don't sell the illiquid junk bonds that have no bid. They sell the stuff that has a market. They treat silver like a piggy bank to pay for their sins in the Nasdaq. So when silver hit 72.21, that wasn't a valuation judgment. That wasn't the market saying silver is worth 10% less today than it was yesterday because industrial demand collapsed overnight. No, that was a margin clerk saying, I need cash and I need it in the next 10 minutes. This distinction changes everything about how you should be looking at the next week. If the drop was fundamental, if mines were closing or demand had vanished, you'd expect a slow grind lower. You wouldn't see a V-shape. The fact that we snapped back to 75.15 so violently tells us the selling was purely mechanical. It was price insensitive. Now, you might be thinking, okay, but it bounced. The mechanics are over, we're good. Here is where it stops making sense if you're just looking at price. That bounce, it wasn't strength. It was the absence of sellers. Once the forced liquidation was done, once that specific fund or group of funds finished puking their position, the selling pressure simply evaporated. The price drifted up because there was no one left to hit the bid, not because aggressive buyers were chasing it higher. There's a massive difference between a rally driven by demand and a rally driven by the exhaustion of supply. One sustains a trend, the other is a trap. And looking at the volume profile from yesterday, the volume on the way up was significantly thinner than the volume on the way down. That's a divergence that usually resolves in one direction, and it's not the one most retail traders are betting on right now. Think about the people who bought that dip. Who steps in at $73 when the knife is falling? It's not the mom and pop investor, they were panic selling. The people buying yesterday were the market makers and the physical dealers who saw the arb. They saw paper silver disconnecting from physical reality and they stepped in to close that gap. But here's the catch. Those market makers are not long-term holders. They are not diamond hands. They bought that dip to flip it. They provided liquidity for a price, and now that we're back above $75, they're sitting on inventory they likely want to offload before the weekend. So we have a situation where the weak hands have been washed out, yes, but the strong hands that replace them are purely mercenary. They aren't married to the position. If we get another shock, say another leg down in equities or a hot inflation print that spikes yields, those dealers will step aside. They won't defend the price. They'll let it drop until it hits a level where they can arb it again. This is why that $72 level matters so much. It wasn't just a low, it was a line in the sand where the liquidity finally appeared. Below that, it's an air pocket. We saw spreads widen out to 50 cents, sometimes 70 cents on the bid-ask during the worst of the drop. That is the sign of a broken market. And this brings me to the contradiction that no one seems to want to talk about. Everyone says they want volatility. They say they want price movement. But yesterday proved that the structure of the silver market right now cannot handle this level of volatility without breaking. The exchanges barely kept up. We saw fills getting slipped. We saw platforms lagging. If you're sitting there with a standard retail brokerage account thinking you can trade these swings in real time, you are the liquidity. You are the one providing the exit for the guys who caused the crash in the first place. I want you to look closely at the open interest numbers that are going to come out later today. I suspect we are going to see a massive reduction in total open interest. That means traders didn't buy the dip, they just left the casino. And when the crowd leaves, the room gets quieter, but the games get much, much more dangerous. We are entering a period where the price is being set by a handful of large players who know exactly where the pain points are. And they know that the $72 level is now a target, not a floor. The instinct right now is to say the worst is over. But when you look at how the bond market reacted to this, and we have to talk about yields because they are the elephant in the room, it suggests that the stress isn't contained to just tech stocks and silver. It's bleeding over. There's a signal coming from the repo market that aligns perfectly with this silver crash, and it paints a picture of a system that is starving for collateral. And in a collateral shortage, silver isn't the safe haven. It's just another asset to be pledged, rehypothecated, and eventually sold. Before we get too comfortable with the $75 handle, we need to understand the mechanism that is going to drive the next move. Because if you think yesterday was a one-off, you are betting against the way modern market plumbing actually works. And that mechanism usually isn't what people think it is. When we talk about market plumbing, most people imagine some complex algorithm or a central bank lever. But right now, for silver, the mechanism that matters is actually incredibly boring and incredibly dangerous. It's the volatility calculation that the exchanges run. Here's the reality of what happens after a 10% intraday move. The clearinghouses, the entities that actually guarantee these trades on the COMEX or the LME, they look at that volatility and they get nervous. Their risk models, these value at risk or VAR models, start flashing red. So what do? They don't care about the fundamental thesis. They don't care if silver is undervalued. They care about solvency. So they raise margin requirements. We haven't seen the official notice yet, but historically, after a move of this magnitude, it is almost a guarantee that initial margin requirements are going to take up, maybe 10%, maybe 15%. Think about what that does. If you are a trader holding a levered position, maybe you survived the crash yesterday. Maybe you held on by your fingernails. Suddenly, you get a notification that it costs you more capital just to keep the same position open. This acts like a gravity well on the price. It forces the smaller players, the ones who are right but are undercapitalized, to trim their positions. It creates a natural ceiling. So even if the sentiment is bullish, even if everyone wants to buy, the cost of admission just went up. This is why V-shapes are so often followed by a secondary drift lower. It's not because the sentiment changed again, it's because the cost of leverage repriced. And this is exactly what the buy the dip crowd is missing today. They're looking at the price, but they aren't looking at the cost of carry. There is another signal here that is flashing, one that is much quieter but much more telling than the headline price. It's the behavior of the spreads. I mentioned earlier that the bid-ask spreads widened yesterday. Well, they haven't fully normalized. I was watching the screen this morning, and even on the standard contracts, the gap is sticky. It's twitchy. That tells you that the market makers, the guys whose job it is to provide liquidity, are still terrified. They're keeping their distance. They are effectively saying, I will trade with you, but I'm going to charge you a premium for the risk that this happens again in 5 minutes. When spreads stay wide, it means confidence is low. Not confidence in the price going up or down, but confidence in the stability of the market itself. A wide spread is a tax on every single person entering or exiting. And when you tax the market, you get less participation. You get a thinner market. And a thin market is a volatile market. It's a feedback loop. Now, I want to pause here for a second, because I need to be honest about the other side of this. There is a scenario where I am completely wrong about this danger. If we get through the next 48 hours and we see silver detach itself from the Nasdaq, if we see tech stocks take another leg down but silver holds firm at 75, or even grind higher on heavy volume, then my thesis about the liquidity trap is dead. If that happens, it means there's a genuine physical bid sitting underneath the market that is strong enough to absorb the margin calls. It means that some sovereign entity or some massive industrial buyer is using this dip to load the boat, and they don't care about the volatility. If I see that, a decoupling from risk assets, I will flip my bias immediately. I'm not here to be a perma bear. I'm here to survive. But right now, looking at the data, I don't see that decoupling. I see silver acting like a frightened animal, moving with the herd. So where does that leave us? It leaves us at a binary point, a fork in the road. Path 1, the margin hikes hit, the liquidity stays thin, and this $75 recovery rolls over. We retest the lows. Maybe we don't crash, but we bleed. We drift back towards 72 simply because there isn't enough leverage allowed in the system to hold it up. Path 2, the panic recedes, the margins stabilize, and silver starts to trade on its own fundamentals again. We start reacting to inflation data, to the dollar, to the things that should matter. But here's the catch. We don't get to choose which path we take. The liquidity providers do. And right now, they're looking at yesterday's crash, and they are seeing risk. The next 12 hours of trading are going to tell us which way the wind is blowing. And there's one specific thing, a structural tell in the charts that usually appears right before the decision is made. The tell is the Friday close. We are staring down the barrel of a weekend, and in a market this fragile, nobody wants to hold risk over a 48-hour blackout period. If the smart money, the institutional desks, the real liquidity providers actually believe this snapback was valid, they would be fighting to keep inventory into the close. They would be accumulating. But if we see the price start to drift lower in the last 2 hours of the session today, if we see that slow, agonizing bleed where every small rally gets sold into, that is the market screaming at you. It's saying, we don't trust Monday. And that brings us to the playbook. Because standing here and analyzing the crash is useless unless you know how to navigate the wreckage. Here is exactly how I am mapping this out. I'm looking at 2 very specific scenarios, and I'm ignoring everything else. I'm ignoring the headlines, I'm ignoring the Twitter threads, and I'm definitely ignoring the analyst price targets that were written 3 days ago. Scenario 1 is the liquidity trap. This is what happens if the margin hikes I mentioned actually choke off the demand. In this world, we see silver hover right here in the mid-75 range. It looks stable, it looks calm, but the volume starts to die. The bars on the chart get smaller and smaller. This is the most dangerous setup. It lures people in. They think stability equals safety. But low volume stability after a crash isn't safety, it's exhaustion. It means the buyers are done, and the moment a new seller shows up, the floor drops out again. If I see volume drying up while we sit at 75, I am sitting on my hands. I am not buying that breakout. I am waiting for the retest of 72.21 because markets have a memory. They almost always go back to the scene of the crime to see if the bodies are still there. We need to test that $72 low again to see if real buyers step in, or if yesterday was just a stopping point on the way to 65. Scenario 2 is the decoupling. This is the harder path, but it's the only one that turns me bullish in the short term. For this to happen, I need to see silver ignore the Nasdaq. I need to see a moment, maybe late today, maybe early Monday, where tech stocks take a hit, where the S&P dips and silver refuses to budge. If the algorithm sells the S&P and buys silver, or even just leaves silver alone, that is the all-clear signal. That tells me the correlation is broken, the forced selling is finished, the margin clerks have gone home. If that happens, then 75 becomes a platform. It becomes a launch pad, but I haven't seen it yet. So what am I actually doing? I am doing absolutely nothing with leverage. This is not the time to be a hero. The implied volatility is too high, the spreads are too wide, and the risk of a gap open on Sunday night is massive. If some news breaks over the weekend, more bad news on the AI front or a geopolitical headline, silver could open $3 lower and your stop loss won't save you. It will just execute at the worst possible price. I am watching the physical premiums. I'm making some calls to dealers to see if the physical market is tightening up. Usually when the paper price crashes, the physical premiums spike because people rush to buy the actual metal. If I don't see those premiums rising, if the physical market is yawning at this drop, then the bearish case is much stronger than anyone admits. And I am watching the dollar index. The DXY has been quiet through all of this, which is strange. Usually a liquidity crunch spikes the dollar. If the dollar starts to wake up and rally, that is the final nail in the coffin for this silver rebound. A strong dollar plus high real rates plus a liquidity crisis is the trifecta of doom for precious metals. The risk right now isn't missing the upside. The risk is getting run over by a steamroller that you thought was parked. If we close today below $74.50, I think the probability of seeing $68 next week goes up significantly. That's the math. It's not about what I want to happen. I love silver. I want it to go to 3 digits just like everyone else. But I'm not going to pay the market to teach me a lesson I've already learned. The structure is broken. It takes time to fix. And usually the fix involves one more flush to clear out the last of the hopefuls. So here is the question you need to answer before the market closes today. Do you trust the V? Do you look at that sharp bounce from 72 to 75 and see strength? Or do you see a dead cat bounce and a liquidity vacuum? Put the answer in the comments. I read them. I want to know if the sentiment out there is fear or greed. Because right now, the charts are showing fear, but the forums are showing greed. And that divergence usually ends in pain. I'm going to be watching the Commitment of Traders report that drops later. There's a specific column in there, the swap dealer's positioning, that is going to tell us if the smart money was catching the knife or stepping aside. I'll break that down in the next video, along with the one repo market chart that nobody is looking at. Stay safe out there. Don't be the liquidity. 72.20